Most people dramatically underestimate the power of relatively small monthly investments because the human brain evaluates money emotionally in the present rather than mathematically across time. $300 per month feels ordinary. It disappears quietly into daily life through food delivery, financing payments, subscriptions, convenient spending, vacations, small lifestyle upgrades, and countless recurring expenses that rarely feel financially significant in isolation. The danger is not usually one catastrophic decision. The danger is repeated normal decisions slowly compounding in a particular direction for decades. And this is exactly where financial psychology becomes fascinating. Because over 40 years, financial systems begin rewarding consistency far more aggressively than intensity. A person does not necessarily need extraordinary income to build substantial wealth. What often matters more is repeated behavior sustained across very long periods, while compounding quietly amplifies the outcome underneath the surface. At first, $300 per month appears almost insignificant compared to larger financial goals. Many people assume wealth accumulation requires dramatic salaries, huge investment wins, or some form of rare financial advantage. But compounding mathematics operates differently from ordinary intuition. Inside this equation is one of the most important mechanisms in modern finance. The future value of recurring investments depends not only on contribution size, but on time interacting with growth repeatedly over long durations. Most people emotionally focus on the monthly amount because that is what feels tangible in the present. Financial systems care much more about the duration of compounding itself. Imagine someone investing $300 every month into diversified long-term assets for 40 years while earning historically average market returns. The direct contributions alone would equal $144,000. But the final value would likely become dramatically larger because investment growth itself begins generating additional growth year after year. This is where human intuition starts failing. Linear thinking expects steady proportional outcomes. If contributions increase slowly, people assume results will also increase slowly. But exponential systems behave very differently. During the first decade, progress often feels underwhelming. The portfolio grows, but emotionally it still appears relatively small compared to the effort involved. Then gradually something changes. The accumulated asset base becomes large enough that growth itself starts contributing meaningful amounts independently. Eventually, the portfolio may begin growing by amounts larger than the monthly contributions themselves. That moment changes how people perceive investing entirely. Because the system begins feeling alive. Exponential growth rarely appears dramatic early because compounding hides its acceleration during the beginning stages. This same pattern appears throughout economic history, population systems, technological adoption, debt accumulation, and market expansion. The curve always looks relatively harmless before the acceleration becomes visually obvious. This delay creates one of the largest behavioral problems in investing. Modern psychology expects immediate feedback. People naturally want visible results shortly after making sacrifices. But long-term investing often withholds emotional rewards during the exact phase when discipline matters most. Someone repeatedly investing $300 monthly may see only modest progress for years, while spending the same money elsewhere produces immediate stimulation, entertainment, or comfort. This creates a constant psychological conflict between present emotional reward and future optionality. And modern economies are designed aggressively around present-oriented behavior. Subscription systems, financing structures, luxury consumption culture, instant delivery platforms, social media comparison, and convenience-driven spending models all compete continuously for recurring monthly cash flow. Most people do not experience these expenses as one large financial decision. They experience them individually, emotionally, and separately. A small recurring subscription does not feel dangerous. Neither does occasional convenience spending. Neither does incremental lifestyle expansion. But over decades, recurring financial behavior becomes structurally important. Because financial systems amplify repeated direction relentlessly. Someone consistently investing $300 monthly is not merely saving money. They are gradually building productive ownership. They are slowly accumulating assets capable of generating future growth, future income potential, and future financial flexibility. Each contribution individually appears small. The long-term system being constructed underneath is not small at all. The opposite pattern compounds too. Debt, recurring consumption, inflation-adjusted lifestyle expansion, and financing dependency all compound gradually across time as well. Financial systems do not morally distinguish between positive and negative compounding. They simply amplify repeated behavior consistently. This explains why people with similar salaries often arrive at radically different financial outcomes later in life. The difference is frequently not intelligence or ambition. It is invisible recurring direction. One person gradually accumulates productive assets. Another gradually accumulates recurring obligations. The divergence feels slow during the early years because compounding has not yet accelerated dramatically. But eventually the separation becomes enormous. Historically, nearly every durable wealth system followed similar principles. Merchant families reinvested trade profits across generations. Industrial fortunes often emerged through continuous reinvestment rather than single income spikes. Landowners accumulated productive assets that generated recurring economic value over long periods. Modern index investing and retirement systems are technologically newer versions of the same underlying dynamic. The mathematics remain surprisingly ancient. The psychology remains surprisingly difficult. Humans evolved in environments where immediate survival mattered more than 40-year optimization. Present resources felt more emotionally important than distant future possibilities because uncertainty dominated everyday life. But modern financial systems reward long-duration thinking disproportionately because compounding magnifies repeated behavior across decades. The strange part is that long-term wealth accumulation often appears visually unimpressive while it is happening. Most financially resilient people do not experience constant breakthrough moments. Instead, they repeat relatively ordinary behaviors for very long periods while allowing time itself to become economically productive. The process feels boring externally because consistency rarely appears dramatic in real time. But boredom is often where compounding hides. A person investing $300 monthly for 40 years is gradually converting time into productive capital. Each year strengthens the productive capacity of previous years. Eventually the portfolio begins generating growth levels that would have seemed unrealistic during the beginning phase. This is where identity often changes quietly. People trapped entirely inside consumption systems tend to view income primarily as something to spend. People building long-term ownership systems begin viewing income differently. Part of earned money stops being temporary lifestyle fuel and starts becoming retained productive capital capable of generating future economic value independently. That psychological shift matters enormously because it changes how people perceive work, risk, time, and optionality. Someone dependent entirely on active income remains structurally vulnerable to interruptions. Someone gradually building assets acquires increasing financial flexibility over time. The portfolio becomes more than money. It becomes stored future autonomy. And this creates one of the strangest paradoxes in modern finance. Many externally wealthy lifestyles remain internally fragile because the appearance of success depends heavily on continuous income maintenance. Meanwhile, many ordinary long-term investors appear relatively average externally while quietly building extraordinary resilience underneath through accumulated ownership. Modern culture often rewards visible consumption socially while rewarding invisible ownership financially. That tension shapes much of modern economic behavior. $300 per month therefore represents far more than a budgeting decision. Over 40 years it becomes repeated economic direction. It determines whether recurring cash flow disappears permanently into temporary consumption or slowly transforms into productive ownership capable of compounding independently. Neither path feels dramatic at first. That is precisely why the long-term outcomes become so powerful later. Most people underestimate compounding because they emotionally judge exponential systems during the least impressive visible stage. Early growth feels slow. The portfolio appears small. Progress looks ordinary. But exponential systems always hide their strength early. The first years build the structure. The later years reveal the acceleration. And perhaps the most important lesson hidden inside this entire system is that long-term wealth rarely emerges from one extraordinary moment. More often it emerges from ordinary behavior repeated consistently for long enough that compounding eventually transforms repetition into something extraordinarily powerful.